This video is going to look at the second method for recording notes receivable, which is the net method. So we'll use the same example that we used in the gross method, right? That $20,000 note that was issued on January 6th for services rendered. So one thing you'll find between gross method and net method is regardless of which method you use, right, the calculations are identical. There's a couple of minor differences. So when we went through the gross method and we calculated the interest revenue and we calculated the payment amount and the present value, all of those calculations are identical. The only thing that's different between the two methods is the initial entry to record the note and then the debit that you use to plug the journal entry when your cash payments are received for interest. So under the gross method, when we received our $400 periodic interest payment, right, that annual interest payment, we would record the cash, calculate and record the interest revenue, and we plugged the difference to the discount. It was always a debit to the discount, right? Well, under the net method, the only thing that's different, all the numbers are the same, we still debit cash, we still credit interest revenue, those two numbers are the same, the plug figure is the same. The only thing that's different is that debit no longer goes to discount, it goes to the note itself. So you'll notice as we work through this that the net method is only slightly different. So let's just refresh. We had that $20,000 note that we issued for services rendered. The stated rate was 2%, the market rate was 8%, and it was a 3-year note. And the periodic payments, which is the interest we received, were $400. That was based on the note receivable and the stated rate. Okay, so in the last video we went through and we calculated the present value of this note. You can do it like we have over here using your calculator, so show me the N, the IY, the PV, the payment, and the future value. Or you can do it using Excel and using the PV function. Either way, you come up with a present value of 16,907. So now let's take a look at the net method and we'll discuss the journal entries that are required under the net method. So the first entry that's required for this is the note receivable, to record the acceptance of this note receivable. So again, we did work for someone. They, instead of us invoicing them or them paying us cash, we decided to accept a $20,000 note in return for services rendered. Okay, the present value of that was 16,907. So under the net method, we simply set up the note not at its gross value but at its net value, which means when we do the initial journal entry to record this, we're going to debit note receivable for the present value of 16,907, and we're going to credit sales revenue for 16,907, right? So it's sales revenue because we provided services, but under this method we're not setting the note up at the full face value. We're just setting it up at the discounted rate. Okay? So remember, our goal in the life cycle of this note is that the note is issued to us, and then each year for the next 3 years they pay us $400 in interest, and at the end of that third year when the note matures, they pay us out the face value of the note, which is $20,000, right? So at this point, we're not in a position to accept that final payment because the note is only on our books at $16,907. So what you'll see is that over the course of 2006, 2007, and 2008, we're going to bring the book value of that note, the net book value of that note, from $16,907 all the way up to $20,000. So that by the time the note matures, all we have to do is record a debit to cash and a credit to note for $20,000, and we're done. So let's see how this plays out. So the initial entry, the note is set up at the discounted rate, and the sales are set up at or are recorded at the present value or the discounted rate. When we receive our first payment on December 31st, we're going to go through the same steps we did in the gross method. The first thing I'm going to do is record the cash I received. Every year, no matter what, the customer is going to have to pay us $400. So I'm going to get that in my journal entry right away. I'm going to debit cash for $400. The second thing that I'm going to do is I'm going to recognize my interest revenue, right? And if you remember from the gross method example, interest revenue is a function of the net book value of the note receivable times the market interest rate, right? So it's always helpful to try and keep tabs of what is the net book value of the note. So why don't we do that over here, okay? So right now, when we did the initial entry, we set the note receivable up at $16,907. We haven't made any adjustments to it, So at this point, the net book value is 16,907. So I'm going to take that 16,907, right? And I'm going to multiply it by 8%, right? So my interest calculation is 16,907 times 8%. So my interest revenue is $1,353, okay? So if you were to go back to that, if you were to take a look at the notes that you made for the gross method, you would notice that that's the exact same interest revenue we calculated under the gross method. The two numbers are identical, there's no change, right? Again, we have a situation where we have an unbalanced entry. We need a debit to balance this out. We need $953. This is the one difference, or this is the annual difference between gross and net method. Under the gross method, we debited discount on notes receivable, but since we didn't establish a discount in the first entry, all we're simply going to do here in this entry is plug the difference to the note itself, right? And so what you'll see is that each year, right, we're increasing the value of the note. So the note was on our books at the initial entry at 16,907. Once I do this journal entry right here to recognize my cash receipt and my interest revenue for the first year, I increase the note by $953 because of this plug. So now the new net book value of the note receivable is 16,907 plus 953. So the new net book value is 17,860. That's what I'm going to use to calculate my interest revenue for the second year. Okay. So again, take a quick second if you want. If you're ready, pause the video, try and go through and do the journal entries for 2007, 2008 if you think you're ready. If not, just follow along and then practice afterwards. All right. So in 2007, what happens? So another year has passed and we're entitled to another cash payment, right? So the customer is going to make another cash payment. Again, that cash payment doesn't change. It's the same every year. It's always $400. Okay, so we debit cash for $400. The second thing that I deal with is the interest revenue. Okay, so I'm going to calculate and record my interest revenue. Nothing's changed. Interest revenue is still calculated as the net book value of the note times the market interest rate. So now we have a situation where the net book value of this note is sitting at $17,860. The market rate is still 8%. Okay. Oops, sorry. So my credit to interest revenue is $17,860 times 8% or $1,429. Again, the exact same number we got under the gross method. The only difference is that this time when we plug the difference, which was $1,029, we're going to plug it directly to the note. Again, increasing the value of the note. So in 2007, we increased the note by another $1,029. So the net book value of the note for the next interest calculation is going to be $18,889. If we go to year 3, which is basically the year the note matures, two things are going to happen. They're going to have to pay us our interest, and they're still going to have to pay us out the face value of the note. When I record these, you can combine them, like I said in the gross method video, but I would keep them separate just to reduce the confusion. So if I was recording this, the first thing I would do is, again, record that $400 cash payment I'm going to get for interest. So I'm going to debit cash for $400, right? Then I'm going to have to calculate and record the interest revenue. Again, interest revenue is a function of the net book value of the note times the market interest rate. And if you look up above, we said that the net book value of the note after the journal entry at the end of 2007 was $18,889. So I take that and I multiply it by my market interest rate of 8%, and that will give me my interest revenue for the year, which should be $1,511. Right? Once again, we don't have a balanced entry and I need to plug the difference. Under the net method, that difference simply gets posted directly to the note. Once we journalize and post this entry here, watch what happens to the net book value of the note. So in 2008, we added $1,111 to the value of the note. So the note is now sitting on our books at a grand total of $20,000. That's exactly where we want the net book value to be. Now we're in a position to record the final cash payout, right? So the last thing that happens with this note is the customer pays out the face value. So we're just going to simply debit cash and credit note receivable for $20,000. And that's how the net method works, right? So your initial entry sets up the note and credits revenue for the present value of the note, right? So what you calculated in the first part of the question. And then each year we record our cash for interest. We credit interest revenue using the effective interest rate method, i.e. net book value of the note times the market interest rate. And then we plug the difference to note receivable. Same thing in 2007, debit cash, calculate and record interest revenue, plug the difference to the note. And at the end of that time, the note is sitting at the face value of $20,000, so we can simply debit cash, credit note.